Hello, everyone. Thanks for joining and welcome back to Wall Street Bullion. Our guest today is Steve Hanke. He is the professor of applied economics at Johns Hopkins University. Thank you for joining us, Steve.
Great to be with you.
Yeah, it's such a pleasure having you come down to Wall Street Bullion. Huge, huge pleasure. I wanted to get you on to talk about everything that's happening in the economy, gold, silver. But first, let's start off with gold. Where do you think gold is heading in 2025, Steve?
I think it's headed up. Right now, it's clearly in a bull market yet, and it's been chopping around a little bit recently. Mainly, it's hit headwinds because the dollar is so strong, and the expectation is that the Federal Reserve will hold interest rates where they are right now for a while, longer than people had anticipated. I think what will happen is the economy will start slowing down. Inflation will continue to go down. And why is that? That's because the money supply right now is still growing at a much slower rate than Hanke's golden growth rate, which is 6%. That's a rate consistent with hitting the Fed's 2% inflation target. And the growth rate now is, right now we've got the growth rate, about 3.7%. It's way below six.
Right.
And so inflation will come down. The economy will start slowing down in 2025, and the Fed will get into its loosening mode of lowering those Fed funds rates some more. And I think the dollar will back off from these very strong position that it's in right now. And when that happens, I think that'll be the catalyst for the gold market to really start continuing the bull run that it's in right now. By
Yeah.
the way, one way to actually trade it that's quite profitable, even in a sideways trade, is to use something that Abe Kaufness and I have developed called the Hanke Kaufness Gold Sentiment Index. And what we do, we text mine all the articles that come out every hour on the gold market, and determine whether those articles are bullish or bearish. And so we get a sentiment signal in real time. And
Wow.
when that signal becomes very bullish, what happens is that it always reverts back towards the mean or even towards the bearish side. So if we have a very bullish signal at the extreme and you're long, you want to be liquidating that long position and maybe going short because it's going to revert back the other way. It swings back and forth, back and forth, and in a day you can have two or three swings in one day. So if you want to get a look at that, even it's www.goldsentimentreport.com.
Everyone watching, I highly recommend you to go to that website. I'm going to put the links in the description below, Steve, so that way it's super easy for everyone to just give it a click and they can go to the goldsentiment.com. I wanted to ask you too about the similarities from now to the Volcker era, from now to the 70s. Do you see any similarities? And I guess what are the biggest differences that you're seeing right now compared to the 70s?
Well, the biggest difference is that Volcker was a monetarist, and he knew that excessive increases in the money supply caused the inflation that we had in the late 70s. And to wring that inflation out of the system, he knew he had to bring the money supply growth down, which he did. As it turned out, he overdid it a bit because they weren't measuring money properly. He
Right.
he thought he was tapping on the brakes just about right, but in fact he was really slamming on the brakes. So we had, in the early 1980s, when I was actually on Reagan's Council of Economic Advisors during that first term of Reagan, we had two recessions. So there was too much slamming on the brakes, but he had the right idea. He was thinking right.
As you know, I'm a big fan of gold and silver, so I can't think of a better platform to partner with than Gold Republic. Gold Republic sells and stores physical precious metals in a simple, secure, and safe way with a buyback guarantee. You can access your portfolio 24/7 via their unique app, which is available for iOS and Android. And the best thing is, I can give you a 20% discount on the transaction fees with the code SILVER20. The link is in the description below. Check them out.
Now, Chairman Powell isn't even thinking right. None of the central bankers are. They don't look at the money supply. They think monetary policy is about interest rates. Monetary policy is not about interest rates. It's about changes in the money supply.
Right.
And right now, we've had a situation where they overdid it, and now they're on the upside, and now they're overdoing it on the downside. Now Volcker didn't have that. He when he came in, the Fed had already made its mistake of excessive monetary growth. He was just wringing the thing out of the system. Now with Powell, we have a chairman who not only has goosed the money supply, and now he's contracted the money supply. The money supply, the stock of money in the United States is actually lower than it was in July of 2022. It's
Wow.
actually about the same. It's slightly lower now. It's creeping up a little bit, but not as I said, it's not up where it should be yet.
What's your biggest concern, Steve, right now with either the U.S. economy, the money supply, or just the global economy? What's your biggest concern right now that you're looking at?
Well, the biggest concern is what's going on in China, because China is really the the key economy. It's the second biggest economy in the world, but as far as commodities are concerned, it's the elephant in the room. What goes on in China determines what's going to happen with most commodities, whether they're critical materials or things like iron ore. If you look at the price of iron ore, it's collapsed because the real estate market is collapsed in China, and the economy is struggling. And right now, by the way, if you look at what's going on in China, uh, they ended up a little over 5% growth this year, but the IMF has them done at about 4% average for the next 4 years. That's awfully slow for China.
Right.
And if you look at the quantity theory of money and the money supply, right now the inflation rate is what in China? It's zero. Their target rate of inflation is 3%. Their actual inflation rate is zero. So they're way, 3% percentage points below the target. Why? Because the money supply to hit Hanke's golden growth rate in China at 3% inflation, you'd need to be growing the money supply M2 at about 11%, and it's growing at about 7.25%. So they have very slow monetary growth, a lot of economic problems,
Right.
in particular sectors like the real estate market. But the main thing is this macroeconomic money thing. Money is the engine of economies. That makes asset prices move. That makes the real economy move, and that makes inflation move up and down. It's all about changes in the money supply. So the big concern for me right now is China because uh, of specific problems still in the real estate market and this slow growth. And they did late last year, the Bureau said they were going to stimulate the economy. But the question is, how are they going to stimulate it? And it looks like they're not going to rev up the money supply. They'll probably end up revving up fiscal spending. And when you do that, you have to remember money dominates. Money
Right.
dominates the fiscal. To find that out, all you have to do is look at Japan. Japan has a very loose fiscal policy and huge deficits, huge debt to GDP ratios in Japan, but very, very slow monetary growth over the last 30 years. And of course, they have no inflation, basically no growth, and they're kind of in in a trap, and that's the kind of trap I am worried, that Japanese trap, where you have loose fiscal policy, very tight monetary policy, and no growth,
Yeah,
no inflation.
yeah, you absolutely nailed it, Steve. Now, what are your opinions or kind of thoughts about, the new administration and Elon Musk coming in and saying we're going to cut government spending, but that's basically cutting the money supply to a degree, right? What are your thoughts there?
Well, it actually it cuts that would cut government spending, but that doesn't mean that the money supply is cut. That the money supply is determined by monetary policy, not fiscal policy. So he's focused on things that relate to fiscal policy, spending and taxing, spending and taxing, and kind of the think of it as the income statement for the government. The government has taxes coming in and spending going out. And if the spending is more than the taxes, you end up with a deficit. And then the question is, well, who's going to buy the bonds that are sold by the government to finance the deficit? And if the Federal Reserve buys them, you monetize the debt and the money supply does go up. But it's the money supply in the Fed. Now, if a deficit occurred, and you were selling all those bonds to the public, the money supply would not go up. So you'd have no effect. So to get changes in inflation, it has to be preceded by substantial changes in the money supply.
So you would need a lot of people online and a lot of people that I interview, they say, the economy or the US economy needs a recession or some type of form of collapse in order to get rid of inflation. Do you agree with that or no?
No, I don't agree. We're getting rid of inflation, and we're getting rid of it because the money supply has been contracting.
Right.
My view is that it's contracted too much. They should have let the money supply come down to this 5-6% year over year rate, and they let it go way below that, and now it's only growing at 3 and 3/4%. So they've kind of overdone it. If they would have just put on the brakes, the inflation would have come down out of the system as it's coming out of the system, and we wouldn't have had the economic slowdown that I think we eventually will have. Now, by the way, the important lesson for the commodity markets here is that, and I think the markets have all this wrong, is that the money supply is anemic in the United States. It's contracted, and its growth rate is anemic right now,
Right.
and inflation will keep coming down. John Greenwood and I predicted at the end of this past year, 2024, we would have inflation at 2.5 to 3% per year. We had 2.9, so we hit it. And we think it will come down to the inflation target of 2% or a little below in 2025. Now, if inflation comes down, bond yields come down, the long interest rate comes down, and that that if anything, if all else remains the same, that would mean the dollar would get a little bit weaker, and of course that would put some wind back in the sails of the bull market in gold.
Yeah. Hello, my fellow silver and gold stacker. I just wanted to say thank you so much for watching the channel. Subscribe, please like the video, and also hit the notification bell. Keep stacking. No, there's so many people talking about, the future for gold and precious metals and silver. When did you first get into to gold and silver? Like when was your first introduction into the precious metals market?
1985.
Oh, no way. Okay. Well, give me a story back from in 1985.
Well, at that time, I was a professor at Johns Hopkins, where I am right now. But at that time, um, Dr. Albert Friedberg in Toronto, Friedberg Mercantile Group, where I'm chairman emeritus, invited me to become at that time the chief economist for Friedberg Mercantile Group, and Al Friedberg was big time into precious metals and foreign exchange at that time, all commodities.
Right.
He's in many other things now, but at that time the focus was on commodities and precious metals, and to some extent foreign exchange. So that was I just dove into the thing, and by the way, the first thing I did is develop a model for the oil market, and predicted in late 1985 that in 86 OPEC would collapse, and oil prices, I said, would go below $10 a barrel, which they did. I was the first one to predict that. We
Wow.
were short, we were short big time. It was quite an experience, especially for me. And after the fact, we found out that the London gas oil contract, we had over 70% of the total London short interest.
Wow.
So we had huge positions there, huge positions in anything related to crude oil, including the Saudi rial, the currency, and the Kuwaiti dinar. We were short those too. So it was a very exciting time. But gold was in the picture, and Friedberg was one of the first ones to actually anticipate that gold was going to take off after they freed it up.
How did you predict the economic model for the collapse of 86 for oil prices? Did you just,
Well, it was basically a plain, what I call a plain vanilla economic model. It was just supply and demand,
right.
and and seeing that not only OPEC did have excess capacity, but the non-OPEC producers were producing like mad, and then the market swung into serious backwardation where the short duration contracts were in short supply, and and I knew that that would pull a lot of oil from the future into the present, and when that oil arrived and got dumped into the present, the price would collapse, and it did.
Wow, that's incredible. Before you leave, Steve, I'm gonna put all your links in the description that we mentioned in today's episode, so that way people can go and click them. But what would be your, I guess, your piece of advice for everyone watching here before you go? What would be your main piece of advice?
Well, I think right now, um, my advice would be 2025 is going to be a year of investing dangerously. So don't get very complacent. Don't go asleep at the wheel. So
Right.
I think right now everybody's very complacent. If you look at the equity markets and things like the VIX, which measures volatility, it's just totally subdued. I mean, no one seems to be worried about wars, conflicts, changing governments, anything. They're
Right.
just, and I think that's something that's basically an error.
Yeah, it seems like a ma massive error to me as well. But Steve, I want to thank you so much for coming down to Wall Street Bullion. It's been such a huge pleasure. And as the market develops, or even as the year progresses, I'd absolutely love to have you back on the show.
Well, even I'd love to be with you.
Awesome.
Happy New Year to you.
Happy New Year to you as well. Thank you so much, Steve.
Yeah, have a good trading day.
Thank you so much.